Chapter 9, Facilities, the True Risk Contract. In corporate lending, the term facility is fundamental yet often misunderstood. A facility is not simply a loan. It is a contractual commitment by a bank to make credit available to a borrower under specified terms and conditions. Understanding the distinction between a facility and the actual utilization of that facility is critical for anyone working in corporate banking, risk management, or loan system implementation. Section 1. What is a facility? A facility represents the bank's promise to lend, subject to the borrower meeting certain conditions. It defines the maximum amount the borrower can access, the purpose for which the funds can be used, the tenor or duration, the pricing structure including interest rates and fees, and the conditions precedent that must be satisfied before drawdown. The facility is the legal and operational framework within which lending occurs. It is the true risk contract because it establishes the bank's maximum exposure, the borrower's rights and obligations, and the mechanisms for monitoring and enforcing compliance. Section 2. Facility versus utilization. One of the most important concepts in corporate lending is the distinction between facility and utilization. The facility is the approved credit limit. The utilization is the actual amount drawn down by the borrower at any given time. For example, a company may have a revolving credit facility of $100 million, but only utilize $60 million at a particular moment. The bank's exposure is $60 million, but its commitment is $100 million. This distinction has profound implications for risk management, capital allocation, and system design. Banks charge commitment fees on the unused portion of a facility to compensate for the cost of holding capital against the committed but undrawn amount. This fee is typically calculated as a percentage of the undrawn balance and is charged periodically. Section 3. Types of facilities. Corporate lending involves a wide variety of facility types, each designed for specific purposes and risk profiles. Term loan facilities provide a lump sum disbursement with a defined repayment schedule. These are typically used for capital expenditures, acquisitions, or refinancing. Revolving credit facilities allow the borrower to draw, repay, and redraw funds up to a specified limit during the facility tenor. These are commonly used for working capital management. Overdraft facilities permit the borrower to overdraw their current account up to an agreed limit. These are flexible but typically carry higher interest rates. Trade finance facilities include letters of credit, bank guarantees, and documentary collections. These may be funded or non-funded, depending on whether the bank disburses cash or simply provides a guarantee. Project finance facilities are structured to fund specific projects, with repayment tied to the project's cash flows. These often involve complex milestone-based drawdowns and covenant-heavy structures. Section 4. Facility limits and sublimits. A single facility may have multiple sublimits that further constrain how the credit can be used. For example, a $200 million multi-currency revolving facility might include a sublimit of $50 million for foreign exchange hedging, a sublimit of $30 million for letters of credit, and a sublimit of $100 million for any single currency. These sublimits must be tracked and enforced in real time by the loan management system. Exceeding a sublimit, even if the overall facility limit has not been breached, constitutes a violation of the facility agreement. Section 5. Facility tenor and renewal. The tenor of a facility is the period during which the borrower can access the credit. At the end of the tenor, the facility expires, and any outstanding utilization must be repaid unless the facility is renewed or extended. Renewal is not automatic. It requires a fresh credit assessment, updated documentation, and approval by the bank's credit committee. The loan management system must flag upcoming facility expirations well in advance to allow time for renewal negotiations. Section 6. Conditions precedent and subsequent. Facilities typically include conditions precedent, which are requirements that must be met before the borrower can draw down funds. These may include submission of financial statements, proof of insurance, execution of security documents, and compliance with regulatory requirements. Conditions subsequent are ongoing obligations that the borrower must fulfill throughout the life of the facility. These include maintaining financial covenants, providing periodic reporting, and obtaining bank consent for certain actions such as asset sales or changes in ownership. The loan management system must track both types of conditions and prevent drawdowns if conditions precedent have not been satisfied. It must also monitor compliance with conditions subsequent and trigger alerts if breaches occur. Section 7. Facility amendments. Over the life of a facility, the borrower may request amendments to the terms. Common amendments include increasing or decreasing the facility amount, extending the tenor, changing the pricing structure, or modifying covenants. Each amendment requires credit approval and legal documentation. The system must maintain a complete audit trail of all amendments, showing the original terms, the amended terms, the approval workflow, and the effective date of the change. This concludes Chapter 9, Facilities, the True Risk Contract.